Welcome to lecture number 34. In this lecture, I shall talk about the concept called capital planning and also the application of evaluation criteria of capital budgeting decisions. Now, after these sessions, you would be getting a complete idea about how the capital budgeting decision is taken. So let me share the presentation. In the last class, or last lecture rather, I have discussed about how we should use, how we can calculate NPV and IRR and also different evaluation method. If you have seen, among 4 evaluation method, that whether we should invest in capital of the non-current assets or not, one is the payback, discounted payback, IRR and NPV. The better method is IRR and NPV because it captures the future value as well as it is also indicating some return generated from the investment. Now in these sessions, in the last class also we have discussed how to calculate IRR and NPV, what is the meaning of IRR and NPV. Now before I start, again I repeat the meaning of IRR. IRR means, suppose if I am actually, IRR of an investment is of a investment of rupees 100 lakhs in a machinery is 11% per annum. It means that that machinery for an investment period of say 6 years is generating a return of 11% per annum. So IRR is the return generated from its investment. Similarly, NPV is also calculated to evaluate a capital budget decision. What is an NPV? NPV means how much that business is generating a return in excess of meeting a discount rate. We will discuss about that. What is this discount rate? Now, business entity has no fund on its own. Always remember, every business entity is running on borrowed fund. Now, when it is raising the fund in the form of an equity or debt, now let us give it, already you know what is the meaning of equity, what is the meaning of debt. Equity has got flexibility of repayment, debt has got no flexibility of repayment. So both will come as a different part. Now the question is that in this case, the business entity need to invest 100 lakhs. Since the business entity has got no fund on its own, so it has to actually take the fund from outside. So when it is taking the fund from outside, then whether it should raise in the form of a debt, whether it should raise in the form of an equity, or it's a combination of the both. Now this decision is called capital planning decision. So how I should raise my fund, which is required in the business. So fund is required in the business for non-current assets as well as the current assets. So in the case of the non-current assets, in this case, I'm giving an example, which is a machinery, that how much of this machinery, the fund of 100 lakhs, I will raise in the form of a debt or in the form of an equity. Now, it depends on many factors. What are the factors? A few of them. Willingness of equity investors or debt lender to lend the amount the entity asked for. In this case, entity is asking for 100 lakhs. Whether those people who are willing to put in the money in the form of an equity or debt, whether they're willing to give 100 lakhs. Next one is that how much I have to pay. The means management of the business entity has to pay to how much the business entity has to pay to whom? To this provider of fund, that is equity holders or the debt lenders. Now, how much return I can generate from this investment? Now, all these factors are some of the examples I have mentioned, which will determine that how much fund I would be raising in the form of a debt or in the form of an equity. Now, whenever somebody is giving the fund, this provider of the fund always expects some return. So this return is called required return. Again, I repeat, required return. Required return is a return expected by whom? By the people who are providing the fund. Suppose I am raising equity from X, an individual entity. So X is expecting some return. So that is called required return. I am raising the money in the form of a loan from a bank. Bank is expecting some return. That is the interest rate. So that is called the required return. Now, required return varies from lender to lender, because one bank to another bank, one provider to another provider. Now, with a given lender, required return would be different when provider of the fund is providing fund in the form of a debt compared to when it is providing in the form of an equity. What does it mean? Suppose, for example, I want to raise 100. I go to X and say that, please give me 100 in the form of a loan. Now, in that case, the X will ask for a particular interest. When I ask X that give me 100 in the form of an equity, X would be asking for a return, which is generally given in the form of a dividend, would be much higher than what it is asking. Because when that particular entity X is giving me the money in the form of an equity, I am not promising anything sure. So in that case, the required return of an equity holders will always be higher than the required return of a debt holders. Because by virtue of the structure of the instrument, an equity hold and the equity instrument does not promise anything in return, in sure return. That means does not promise anything sure return. So the risk is high from the investor's point of view. So that's why the investor will ask more return compared to the same investor when it is giving the money in the form of a debt. So required return of an equity is always higher than required return of debt. Now, investment in equity is risky, so required return would be higher. The job of finance department is to find providers of fund who would be requiring lowest return, both in the form of a debt and equity. So one of the major job of a finance department to source people who are willing to lend money at a lower cost. Now, so what are the steps it should follow? First, it will determine the mix. In this case, the entity decides that 100 lakhs would be raised in the form of a debt and equity to the tune of 60 and 30. That means in this example, what I am talking about. Second, choose the debt lender. So that means now the finance department will now source or start discussion with different banks that which is willing to lend at a lower rate or not. So based on that, the bank A is willing to lend at 8%, bank B is willing to lend at 9%. So the entity would borrow from A. Now, this entity, let us look at it, how the different debt and equity mix can be used out. Suppose the entity can raise debt 60, equity 40. The entity can raise debt 70, equity 30. That entity can raise 80 debt, 20 equity. Now, in the case of the 60-40 ratio, the interest rate is 8%. In the case of the 70-30 ratio, interest rate is 8.05%. And in the case of 80-20 ratio, interest rate is 8.50%. Why it is? Since the entity is raising more debt, leverage of the entity is going up. If you can correlate now, the leverage ratio, higher the leverage, riskiness of the entity goes up. Since riskiness of the entity is going up, so debt lender is considering the entity is more risky here. That is, it is demanding more interest rate. If you see, debt lender is saying that riskiness slightly increasing, but the moment it is going to 80-20, substantially riskiness is increasing. That's why it is charging a high interest rate. Now, in this case, choose the equity lender. Entity X who is willing to invest at 14%. Entity Y is willing to invest at 15%. So definitely the entity would borrow from X. Now with the debt and equity mix, it will not this interest rate. Just let me actually change it. It is not the interest rate. It is basically what we talk about it is basically the cost of equity. Return on equity. Return on equity. That means how much the equity holders are actually looking for, the return on equity part. So return on equity. So if you look at the return on equity part, slightly I will make it here. So this is a return on equity. So if you look at a return on equity again, so return on equity would be on percentage. So return on equity in that case would be this. So in this case, what will happen? Now we will calculate the return on equity. Interest rate is this. So now we find out return on equity. Now you look at it. Return on equity is 14, 70, 30, 14.5 and 80, 20, 17. Why? Because if at 80, 20, the equity holder is treating that entity is a very sharp increase in riskiness has happened. So that's why it will require more return. Now, if you find out what is the most optimum structure, how do you arrive at most optimum structure? It is called weighted average cost of capital. Now, if I look at it, weighted average cost of capital, how do you have arrived at? Yes, I have shown you example of one. So that means the debt amount, equity amount, cost amount, and that divided by the total amount. So if we look at it, by increasing the leverage here, 9.99% is the weighted average cost of capital. So optimum mix is here. So that is called the weighted average cost of capital. So what we have discussed, how much a particular business entity would be raising, what would be the composition. This is decided something called capital planning exercise. Now capital planning exercise, one part is the capital structure. How much would be the debt and how much would be the equity. It depends on that whether these debt holders or equity holders willing to lend, at what rate, whether this particular borrower has got good network or etc. or not. So that is the way we calculate. So always remember, the required return is the return expected by these providers of fund. So weighted average cost of capital is the which return? This is the return expected by this provider. So required return and weighted average cost of capital are synonymous. Next, now let us look at it. There is something called tax shield. Now in the case of the debt, if an entity is, now please, there's slight deviation here. Here I am bringing a new concept, is that called tax shield. What is tax shield? That means if an entity is raising in the form of a fund, in the form of a debt or in the form of an equity, whether the entity gets some benefit by preferring a particular mode. Let me explain it. Is there any benefit of raising the fund in the form of a debt over equity? Now, what is the benefit? First of all, ownership. Ownership means the entity is not parting the ownership. In the case of an equity, it is giving the equity shares, so it is parting ownership. So one benefit is the ownership. Second is the cost, because the cost is lower in the case of a debt. Third one is a tax shield. Now let me explain what this tax shield means. A business entity would be raising 100 lakhs for investment in non-current assets. Option 1, 100% equity. If it is 100% equity, that means 100% means 100 lakhs in the form of an equity. Cost is 10%. So in that case, the cost is 10. Tax deductive expenses is 0 because equity cost is not tax deductible. So effective cost is 10%. Now if you look at it, here I have taken this equity cost same with a debt equity ratio of 60-40. So next option 2, debt is 60, equity is 40. Now debt interest is 5%, so that is cost is 3. Now if the particular entity is a bucket of, is a tax bracket of 25%. So that means this 3 rupees cost would be deductible. So on 3 rupees, the 3 lakhs of rupees, the entity will save 75 lakhs. That is 0.75 lakhs, not 75 lakhs, 0.75 lakhs. So what does it mean? It means that the effective cost of debt is not 5%. So how much would be the effective cost? That is 3 minus 0.75 divided by 60. That gives you the 3.75%. So when an entity is raising the fund in the form of a debt, it gets 3 benefits: ownership benefit, cost because of the weighted average, because of the required return on debt would be lower, plus it will also get the tax shield. So when we calculate the weighted average cost of capital here, this is inclusive of tax shield, because here the interest rate I have taken is inclusive of tax shield. So what does it mean? So tax shield, so weighted average cost of capital means that this cost, which is after giving the impact of tax shield, is factored in here. Now, how do you evaluate? As we have mentioned, we can use either IRR method or NPV method. If we use the IRR method, then the following process is to be adhered to. Number 1, find out the IRR of the project. This IRR, how do we make the project? As we have already discussed. Always remember, IRR is the business return generated from investment. How do you calculate IRR? A discount rate will make the NPV 0. That is the net present value 0. Is this the IRR? But in Excel, you can do the IRR immediately. You can calculate. So IRR is 11.85%. Next is that, should I accept it? Find out the required return. This is called weighted average cost of capital. Now, as we know how to calculate weighted average cost of capital, in this case, the weighted average cost of capital is 9.99% per annum. Since it is 9.99% per annum, in this case, business return is more than the required return, one should accept the project. So if IRR is greater than weighted average cost of capital, then one should evaluate the project. In this case, IRR is greater than weighted average cost of capital, so project is accepted. If we use the NPV method, following process is adhered to. First, find out the NPV of the project. By using, if you can recollect, for calculation of NPV, we need discount rate. So what is the discount rate? Weighted average cost of capital is the discount rate. So first you find out weighted average cost of capital, and you find out the cash flows, and you find out the NPV. So in this case, at a discounted rate of 9.99%, it is 5.75 lakhs. Previously, we have calculated at 9% discount rate. So that's why NPV was higher in the previous case. Step 2, find out whether NPV is more than 0 or not. In this case, NPV is 5.75 lakhs. So it is more than 0. So it is accepted. So what does it mean? This 5.75 lakh means the project, after meeting the required return of 9.99%, an extra is generated of 5.75 lakhs. So if the project generates more and more NPV amount is more, the project is safer or more attractive. So what you have actually learned, how to evaluate a capital budgeting decisions. Before we finish it up, let me sum it up in 2-3 minutes. First, capital budgeting decision means whenever you are procuring a non-current assets, the activity, whether I should go ahead or not, is called capital budgeting. Since it's a long term, risk is high, inflow and outflow will take place at different point of time. So time value of money should be applied for evaluations. So first question, what is, and you should scrutinize several times whether I should go ahead with or not. First, we should ask, what is the existing capacity of our plant? If it is low, why I can't use the existing capacity? If it is already high, then okay, fine. Next, what is the demand? If the demand is not high, then why I should take the asset investment? If that is yes, next I find out that what would be the cash flow generated over a period of investment period. Every capital budgeting will have an investment period. Now what we find out is that what is the outflow today, and then each year what would be the inflow over a period of the investment period. Now for one particular year, the inflow is PAT plus depreciation plus interest associated with the borrowing. Which borrowing? The borrowing which is going to funding that particular asset. It's not the overall borrowing. That's a very important point I'm making. From that, I will deduct the current assets minus current liability. Current assets minus current liability, I've explained in detail what it is. It is the amount of income which I am not being able to realize. Suppose my profit is 20. Out of that, the money blocked is 30, but out of the 30, I have already funded from my creditor and bank borrowing is 25. So the amount which I have not been able to collect is 5. So this 5 would be deducted from that part, that is PAT plus depreciation plus interest on that particular borrowing. From that routine capex also I deduct. So by that way we find out each year what is the cash flow. Then once I find out each year's cash flow, then I take evaluation method whether I should go ahead with or not. For the case of the evaluation method, I can use a very simplified method called payback method. That means I sum it up, what is the total cash flow for 6 years and what I am investing today. But this is unscientific because since the timing is happening at different point of time, so the time value of money is not captured at all. Slightly better is the discounted payback method, so which captures the time value of cash flow. But discounted payback does not indicate how much return I am generating, whether it's worthwhile to get a return. For the calculation of that further improvement of evaluation, we use IRR and NPV method. IRR method is internal rate of return expressed in percentage and NPV is in amount. So if I use IRR method for evaluation, first I will calculate the IRR of the project, cash flow, then discount, then we use an Excel, then we can get an IRR. But if you don't use an Excel, we use a formula that is a discount rate which makes the NPV 0. Now then we calculate, that is called IRR is nothing but the business return. Then we calculate what would be the required return. Required return would be governed by capital planning decisions. That means how much of the capital structure of that entity, how much would be debt, how much would be equity. The required return is the return expected by the lender. Required return of an equity would be higher than required return of debt, and it depends on the leverage. So I find out the optimum structure and find out the required return, which is synonymous with weighted average cost of capital. Now IRR is a business return. If IRR is greater than weighted average cost of capital, then we accept the project. Now if NPV, for calculation of NPV, I have to get the discount rate. This discount rate is nothing but weighted average cost of capital. And if the NPV is greater than 0, I accept the project. NPV greater than 0 means that the project is generating a return after meeting the desired return, how much extra it is generating. So if we do this method, that if NPV is greater than 0 or IRR is actually greater than business return, IRR is a business return greater than the required return or weighted average cost of capital, then we accept the project. So this is the capital budgeting decisions evaluation purposes. So you have learned another important point of finance, that whether you should go ahead with the capital budgeting or not. Thank you so much for listening to this video.